I'm Tim Quast. This is the live demo and discussion for Market Structure Edge on September 21st. Welcome. Good to have you here. Thank you for joining. Only two rules are that please mute yourself while we go through comments and then ask questions. The whole point of these sessions is to help you use the platform better, share our own experiences, and take advantage of the views of the veterans here, which is always very helpful. So I'm going to answer questions. I've gotten a bunch of questions via email, and I don't know, Robert, if you're here, and James, if you're here, I'm going to take those. I've only got so much time, and I'm going to take your questions in particular because I thought they would be helpful to everybody. I'll begin first, though, with where are we? And it's a great reminder about the things that we focus on, which is what's broad sentiment, what's the context, what's happening in the cadence and calendar of the market. Every day is not a new day in the stock market. There's a rationale and a process in the markets, thanks to the way that the markets work. The fact that there are big index funds, exchange traded funds, quants who have to do certain things, and that creates a rhythm to the market. And there's a calendar for options expirations. Derivatives play a big role. So knowing those things right off the bat is an advantage because most people don't talk about them. It's, occasionally you might hear something from CNBC about options expirations. A couple of folks mentioned it last week, I heard, but it extends for a period of time. So that's one thing to think about, and I'm going to take a quick look at broad market sentiment here. This is that a reflection of that, the rhythm of the market, so to speak. Money waxes and wanes because just like you and I might do. I've got meetings with our financial advisors to talk about our allocations. And it's the same thing big institutions do. Are we going to be more or less committed to equities or fixed income? And that manifests in the broad sentiment of the market, the green part of the graph. And the supply of the market will oftentimes manifest how global macro money, the big hedge funds, AQR, Bridgewater, the Millennium, Point72, could go on and on, maybe long and short to try to mitigate their exposure to uncertainty. Well, we can see all that. That's very helpful to be able to see. It's not perfect. There's no perfect mechanism. Dan, I saw your email about the correlations and the supply-demand balance versus price is the highest correlation. I think the correlation coefficient was close to 76%, right? So it's a 3 out of 4 shot if you follow this rhythm of the market of being correct. It means 1 out of 4 you won't be, but that's why you have to take steps to protect yourself. Context, you can always, I won't do it here, hit using Edge. This will take you out to marketstructureedge.com and look at resources, and you can look at the calendar where these, if you're new, these little green squares that you see indicate where options expire. Monthly expirations, month-end futures contracts. Why do we highlight those and not all the weeklies and dailies and so on? Those things are very short-term and speculative, and they don't have a lot of underlying asset movement, but these do. And so they have a much bigger effect on the underlying assets, which are equities. So we make sure to follow those, and notice that we're right in the, in the midst of that here. Yesterday were VIX expirations, volatility as an asset class. Back up, a few days from that were the September expirations. And oftentimes the market will do strange things there. Not every time, but if you see that the broad market sentiment is topped and options are expiring, it's probable that at some point the market's going to go down, and that's sure enough what it did. And notice that the corner turned when options expired in August, and the market rose. It's not perfect. It's not a metronome. There are all kinds of other things that come into play, and we're not saying these are the only things. They're just important things to understand. And then we look for divergences. So if you look at the broad market right now, the demand measure, it's an algorithm that meters buying and selling by investors and traders on a 10-point scale. So 5 means buying and selling is pretty close to balanced. It's at 4.5. It's been there 2 days, so it's not falling anymore. That's a bottom. Doesn't mean it can't deteriorate again. It did back here in August. We hit 4.5, 4.5, 4.5. Options expired, and the bottom dropped out. And then it took a little longer for the market to recover. Derivatives can have that effect, and I think there was a lot of use of that going on. But you look at where we are now, where we were then, and you come down and look at the supply side. Supply was higher then. It's tailed off significantly now. Again, I can't tell you what precisely is going to happen, but mathematically, the odds are very high that the market recovers. And knowing that can be a helpful thing. So that you can, if you only trade broad measures like the S&P 500 and some maybe an exchange traded fund, you can mitigate your losses by using this, and that's all you need to outperform the market. If you can avoid dips, big declines, and capture moves, boy, you're at a huge advantage, and you don't have to study a bunch of stocks to do that. That is one way to use these data, and I bought a leveraged. I put in a limit order at for SPXL. I don't know whether it's going to be. I always put a careful stop in. I'm not going to take big chances. But if I look at this data and say, well, if it gets to 81, 85 or so, I think I put my order in at 81, 82. It filled just before this. So I don't know. Could be wrong. But there's also a very strong probability that I could make 3% tomorrow if the market merely recovers what it has given up today. I'm not saying you should do that, but it's my, I have great confidence that these data reflect the way that the market works and what the money's doing. And sometimes I'm wrong. And, I don't like to take chances particularly. I like the math to be stacked in my favor. So where I think we are, boy, we'll see. I think there's a very high probability that the market recovers here into the end of the quarter, but it doesn't mean it will. Just going on the math, there's a 3 out of 4 chance that it does. We'll see. Let's see here. Now I want to get to these questions, and this won't take long. Robert, you asked this. I'm going to use your question because it covers a number of things. You said Apple. Sorry, to refresh that, I didn't clear the cache. All right. So if we look at Apple, your question was, Apple was at 1.8 and the price rose. You were asking about, well, how come the price rose if demand is falling and supply is rising? And I said, well, it's not a metronome. It's not a perfect indication of what will occur. There are multiple factors that feed into this measure. In fact, all motivations feed into demand. And so you don't know absolutely. There can be times when things do behave in ways that you don't anticipate. Plus, that was right during options expirations. That can be a factor. So to me, what you want is rising demand. I mean, again, it's a much higher probability. Can you buy Apple when it's at 1? Well, you can. I prefer to buy it when it returns to 5. That's where you get the gains. If you look at what Apple has done and you just waited till it returned to 5, you'd probably be fine. Now, I don't like this big jump in supply. There are better things. I like to stick with the math. There are great times to own Apple and less great times to own Apple. But again, the core takeaway is prices don't do exactly what the supply-demand equation says. There is high correlation, but not perfect correlation. There's no perfect correlation in the market. And James, you had a number of excellent questions here. So I want to just address a few of those. I can answer most of them fairly quickly. You said, are users generally checking Market Structure Edge for ideas, to find ideas, or do you take your ideas and check them with Market Structure Edge? And you could do either. I mean, if you're very confident in the things that you like to trade, check supply and demand, because it's a potent way to understand the probability that a price rises or falls. It's, to me, much better than technical indicators, because technical indicators long predate the rule structure that we have today. Again, those of you who are excellent technical traders, I tip my hat to you. I can't find reliable predictive correlation between technical signals and how stocks behave, but I do find very high correlation between supply and demand. And you can always look across your dashboard too, by the way, and look at that. Nothing in momentum. Can you go trade the one stock that's in momentum? Probably, but this alone is telling us it's not a momentum market, and we've known it, and it's been true. It's not a good predictive signal of what the overall market's going to do, but it will tell you that you probably should look here. If there are 34 in low volatility and 1 in momentum, it is a market where people are trying to protect themselves. That's what it means. And I look at the performance of the market. It has borne that out. But these are our idea categories. If you don't have much time, we feel very confident about the data in those. Again, it will depend on the broad market's sentiment. When it's rising and you go trade divergences like this, it could be at 5 and falling, could be 10 and supply falling. These are representatives of those portfolios, but it's a way that we think about the market. Then if you want to pursue your own ideas, you can do that very easily. You could, type in stocks. Let's just pick some here, and I'll show you how that works. Oops, sorry. Yeah, I'm just picking names off the top of my head. Let's put CCJ in there. It was just in momentum. So you could then, call this my stocks. And create that. And then you could use these data to help you know what to do. You can look at it very quickly. And I think I'll answer several of your other questions this way, James. So, what's the first thing you look at in a portfolio? Well, I'm going to look for what stuff is topped or bottom. I think I'm missing one in there, didn't I? Let me just edit that. I didn't pick up CCJ. Okay, there we go. Okay, so the first thing I look at is this. What's the demand? Well, there's 5 and bottom. That merely means that it's come down from some higher read, which was one of your questions, and sits at 5, and it's been there at least 2 days. That's all it means. If something says 5 and topped, it means it rose to 5 and stopped rising. That's all it means. 1 and bottomed means it's spent more than 1 day at a bottom. But I'd look at these and say, well, there are only 2 that would interest me here currently. I'd say Google that could potentially be a good value trade or low volatility trade, and CCJ 10 and up, that can only be true on 1 day. The trend can be up for a stock at 10 only when it arrives there. If it spends a second day there, it's topped. That's all we're doing. Very simple measures. We just want to know generally it's the central tendency where things are. So, this is a great example of diverging supply and demand. Demand strong. This is what we call the Hicks Rule. The Hicks Rule is when stocks rise to 10 and get there and their trend is up. So first day they got there and the supply side is falling day over day. And the stock is down half its intraday volatility, which is this, so 3.4%. There's a very high probability that you can make some portion of that when that condition exists. In fact, I think it was CCJ today that I was looking at. I didn't buy it because I want to do what I say to people, right? So I thought, well, there's not momentum, so I'm going to focus on low volatility. But I looked at it when it was down 2.3%, and I thought I really should buy that. And you see right there, why does that matter? Because machines determine volatility, the difference between the highest and lowest prices daily on average over a 5-day period. That's what that math is telling us. And so when something is down, that machines do that, they're going to calibrate how to move prices around and how to make a tenth of a penny sitting between other people's trades, maybe even their own. That's the way that the Citadels and Hudson River Tradings and Quant Labs and Susquehannas and so on make money. And so it gives us a very good indication. If the stock's down that much, what's the probability that it will rise? Well, very high. It will push up to where it's probably, something like 2.5% from where it was, and then machines will lower it again. Well, we can use that to our advantage. I prefer to do that over a couple of days because you can't outcompete machines in the day. They have much better information. They can see supply and demand, but it works very well. Not every time. but it's a great principle. Going back here, so I'd look at that, and I'd look at Google. Google's going to have a much lower return probability, but also lower risk. So if Google is down, since it's got intraday volatility of 1.9%, if it's down 1%, I don't have to set my stop much lower and probably not have as much risk. I'm going to have a smaller return, but these are ways to make money in any condition and not have to spend a lot of time thinking about it. So those were core questions. Let me get to the rest of yours, James, and I'll hand it off to Brian here shortly. If demand value is already at 10, does that mean it's too late to enter? No, it's a core momentum principle. Stuff at 10 with falling supply shows a very strong probability of delivering additional gains. I'll take us back to CCJ. Was that 10 with supply coming down? Boy, it continued to deliver gains until demand waned. Then it flattened. Not bad. In fact, you could own CCJ this entire time. Own it as long as it's above 5, and look how well it's done. That's also a principle for longer range holdings. It's a very good principle because it reflects what all of the money is doing. But 10 with falling supply, boy, that can give you really nice returns. And we use it all. I use it all the time, as long as the broad signals are working for us. So I think I addressed what does demand trend sometimes say topped if demand value is only 5. It just means it's gotten to 5 and it didn't move off of 5. You'll see that a lot in the low volatility portfolio. By the way, there are all of these things listed and described here. If you click this question mark, it will tell you the core behaviors and how we think of these behaviors, all of which we measure quantitatively. We measure trade execution data, and how orders are handled helps us understand what they're after. If money hangs out and tries to get a lot of something at the same price, it's very likely to be active investment. That's not the way passive investment behaves. Passive money wants the average, particularly the reference price, which comes in the last hour. Fast trading, if the price goes banging through the market changing, that's unlikely to be investment behavior and very likely to be fast trading. If it's paired with a counterparty, we know it's probably related to the options or some other derivative. It's just a central tendency again, but we're going to know that. And here's the description of all those key terms that we use. What is short volume? What's the S trend? What's dollars per trade? James, this was another question you asked, so I want to hit these really quickly too. Here's dollars per trade. It is the amount of money in a trade before the price changes. Prices change all the time. These are very liquid stocks. The Russell 1000 averages, call it about $8,000, $7,000 per trade. And in fact, anything above $3,000 a trade is in the top 1,000 most liquid stocks in the market because the prices change all the time. AMD trades over 100,000 times a day, right? They just get fragmented into all kinds of trades. So we prefer liquid things because we can get into and out of them without the price changing on us. You try to trade something that has $500 per trade, very difficult to keep your gains. Price will deteriorate immediately on you when you try to sell it. So to reduce that risk, we try to trade liquid things, and that's what we use in these portfolios. Let's see. The other thing was, I think I've described it. Volatility. This is the 5-day spread between the average high and low prices intraday. You say, well, how would I apply that? Is it versus the closing price? If a stock is down 2% today and it has 3.4% volatility, that's a pretty good entry point, all other things being equal. I can't remember. I bought one of the low volatility stocks today because it was down more than half its volatility. I think it's BKR. Yeah, I just took the first one on the list. I didn't think more about it. When BKR's down, I like the supply-demand equation. It doesn't have much supply. It's liquid. Energy's pretty good right now, so not that necessarily factors in, but and it may or may not work out, but I'm pretty happy. I'm very comfortable knowing that I'm in a range where I have a high probability of producing a return, and it's kind of that simple. Okay, last questions, and Brian, I'm going to hand it off to you. Coin. So this was James. You said with coin. I think it was the one stock in the momentum portfolio. And I don't like when broad sentiment is below 5 and not rising, and a stock is in the momentum portfolio and it's not at 10. I don't love it. Look, the math does what the math is told to do, and sometimes it will give us imperfect findings. But I think it was on the 18th or 19th when it was in the portfolio thereabouts. And both these days, you could have made money on it. Rising demand, falling supply. Intraday, the coin moved roughly, call it $3 or $4 each of those days. So if it was down, its volatility, and you bought it, you could probably exit the same day. It's a more risky trade. Looking at it now, would you be interested? Not at all, right? Demand's not rising, supply is not the thing to own. Those are some answers to questions that come up oftentimes, and I'm going to hand it off to Brian here. Okay, I'll stop sharing.
Okay, and Tim, I'll actually ask you a question here for a second. I was talking with Godwin yesterday, and he was trying to work through a portfolio where price per close was going higher and sentiment was around $5. Now, obviously, it's easy to pick up, the sentiment. You can input that. Is there a way currently in the system where you can track prices that are going higher, or conversely going lower? If you were looking for a short portfolio, you can do it by price. I didn't see a way, but maybe you're aware of a way to do that.
Whether price is rising, I would say, so you're Godwin. If you're here, you're a technician, right? So it's not something I necessarily think about. And you can say, well, why not? And I'll say that because we're market structure focused, and I find that market structure is more reliable. Right. The only thing you could do, if I just pull up Baker as an example here, Baker Hughes, this is just closing price. It's not showing us intraday volatility. Behind the scenes, do we capture that data? Well, sure we do. But could you see it here? I guess you could. You could also just go check it, right? You certainly could do this. Do I do that? Not necessarily. But if you know something that works, you might have to incorporate something like this to see price. But am I going to look at that? I will certainly. What I will look at, I'll tell you one thing that I look at that the system doesn't do a great job at. It's this. If there's high supply and supply falls, I don't like it as much as supply that's been below trend and then continues falling. That's not price related, but could you see price? Well, yeah. I don't know if that helps you. That's all I would have, Brian.
Thank you. Appreciate that. Tim has to go at the top of the hour, so I think I'll keep mine pretty simple here, and maybe I had a couple of different things to go through, but maybe I'll just do one today. And I'll actually just...
I chewed up more of your time. Apologies.
Oh, you're fine. And I think I'll walk through what I was looking at when I set up a trade yesterday. And it's a good example. And Tim, says it all the time, to not trade price, but to trade supply and demand. And I'll show you what was happening at the end of the day. So I have a portfolio, and I do this for most of the sectors. I get to the right portfolio, sorry. So what I'll do is I'll do the largest companies. So this is what it looks like. So here's information tech. I was looking at this yesterday. The reason that I traded, and I traded a 2 times leveraged tech trade. And what I was looking at was sentiment starting to rise and really good short covering. I was very impressed by the short covering, and end of day tech was down a lot. I'm like, okay, well, I'm going to take advantage of this. Well, here's something that I really didn't consider in the trade, or should have given it more merit. Look at where sentiment's at right now. Now, is it starting to rise? Yes, but it's starting to rise off of a very, very low base. This would be a much more effective trade if sentiment was, 5.1, 5.2, and we saw that type of short covering. So I blew it yesterday. I'm going to hold on to this trade because I'm going to watch to see what happens with demand. I'm actually going to average down just a little bit in it. By the way, if you're interested in setting up kind of that big company look, it's very simple to do that. You can just click right here if we're doing tech stocks, And the reason that I set that up for the different sectors, it's a way to see what the big guys are doing. A lot of times the big guys will move before anyone else. So if you're doing that, just take a look, and you might go down the top 10 or what have you, or maybe there's just a easy demarcation point there, and then just go and form a static portfolio. So you would grab Apple and Microsoft and Nvidia and TSM, etc. Make that a static portfolio, and then what you get is what I was just showing you there. And as you can see, I have that for other portfolios as well. Here's my consumer discretionary. You can see short volume starting to move lower for the big companies at a faster rate right now than the sector as a whole. So it's just a consideration, another way of looking at the data. And once again, yesterday I traded price and not supply and demand. Good lesson for me as well. I probably should have been waiting for sentiment to climb above 5 before getting into that trade. Got a little anxious. Probably had that. If you're familiar with the market at all, you'll hear fear and greed. I got a little greedy yesterday. It happens to us all, but it happened to me with yesterday's trading. So, and I'll stop it there. And I think, Tim, you got to go here in a minute, but
I do, but fortunately it's
Yeah.
upstairs. So
Yeah.
it's easy for me to bolt out the door at the last moment. So I don't know why my hand is up. Apologies. I somehow did that. Ignore that. Yeah. How about you guys? Comments, questions, observations? John, you look like you got something to say. No?
Just waiting for the SPY to turn, see the data tomorrow. Pretty big down day. I think this is where market structure is important, but also broad market structure gets to be hard too. If you look at where rates moved to today, you can definitely see the models are shifting, right? So I think in the next week we'll see what people are doing to their allocations, and so that'll come through market structure. But yeah, luckily Brian and I were talking yesterday, but I did not get in early, thank God. So I waited, but that's why I also trade the futures, because I think I can trade them whenever I want versus just the SPY. It's a little bit more liquid and easier. So
yep,
we all have our own styles.
Godwin, what you got?
Yep, I'm trying to respond to Brian because he made a mistake trading. So yesterday, actually the whole week, I believe the whole market is down. It doesn't matter which one you trade. I lost a lot because I trade. But I'm thinking maybe it has to do with Tim mentioned, which is what's it called? Expiring date of whatever is happening there, whatever is called every month it expires. That's why I think the whole market is kind of crazy, even today. So I believe they are expiring tomorrow. I believe they're September 22. That's what I'm thinking, but that was happening because I know I lost a lot because stupidity. I trade yesterday, or actually the whole week, so I lost a lot.
Tim, are you still present, or did you have to leave? I think Tim might have had to take off for his other meeting. Once again, I'll share one thing here before we take off. I wrote about this morning. I talked about, and John mentioned it to a certain degree just a moment ago. We're talking about, I was talking about messy bottoms, and can be messy tops as well. So what I'm referencing here, and you can see it right through here, sentiment, the green line moving lower over time. We're getting into a market bottom. And the analogy I used this morning is coming down a hill. You can see that hill right there, right? You can see the market moving lower. Recognize that when you get that type of movement in the market, there's pent up energy that's going to carry that market forward for a period of time. I think we're kind of in that carry forward right now. We're obviously seeing further declines today. When you're going downhill for a little while, it takes a little bit of extra effort to get it moving the other direction. So we're in that phase right now where we're trying to get that extra effort to get it going the other direction. We'll be watching, broad market sentiment here over the next couple of days to see if we can lift the market above our 5 sentiment and see what type of energy we have there. But, just that analogy, once again, when you're coming down a hill, it takes extra energy to stop the momentum. And same thing when you're going up a hill. Look at the market back here, where sentiment is rising. Look at the market rise as well. And that's part of the reason why when you get 10 sentiment, why it can be pegged to 10 for long periods of time. There's built up positive momentum in the market at that point. Right now, we have built up negative momentum, just the opposite. So I think that's it for today, guys. We'll leave it at that. As always, Tim, myself, Henry, we're all available if you guys have questions. Thank you, as always, for jumping on the call. We really appreciate that, and we hope you guys have a great rest of the day. Take care, guys.